Hey everyone! Today, we're analyzing two companies that crushed their earnings this week: AppLovin, ticker APP, and Dave Inc., ticker DAVE. These are two completely different businesses that both delivered monster results, but the market reactions couldn't have been more different. AppLovin, the ad tech platform disrupting mobile gaming, beat expectations and guided higher, yet initially sold off due to algorithmic confusion. Meanwhile, Dave Inc., the membership-based banking platform, delivered record-breaking numbers but saw its stock crash by 22% in a single session. Today I'm breaking down both earnings reports, explaining why the market reactions were wrong, and giving you my specific buy, sell, or hold recommendations on both stocks with exact price targets. AppLovin Deep Dive, the ad tech disruptor. Let's start with AppLovin, because this company is quietly building one of the most impressive business models I've ever analyzed. APP is an ad tech platform that helps mobile game developers acquire and monetize users through advanced AI and machine learning. Here's what makes them special. They don't just show random ads to random people. Their AXON platform uses sophisticated algorithms to match the right ads with the right users at exactly the right moment. This creates higher conversion rates for advertisers and better user experiences for consumers. Looking at their Q2 earnings, the numbers are staggering. Advertising revenue was guided from $1,195 million to $1,215 million. They landed at $1,259 million. That's a 4% beat on already aggressive guidance. That represents 77% year-over-year growth and 9% quarter-over-quarter growth. For a company of this size, those growth rates are phenomenal. Adjusted EBITDA was guided from $970 million to $990 million, and they delivered $1,018 million. That's an 81% adjusted EBITDA margin. Let me repeat that. 81% margins on over $1 billion in revenue. Free cash flow hit $768 million, up 72% year-over-year. This company is a cash printing machine. But here's what excites me about AppLovin's future. They're launching their self-service portal called AXON Ads Manager. Starting October 1st, they'll begin a referral-based rollout, with a global launch planned for the first half 2026. This is huge because it opens up their platform to millions of small businesses worldwide. Right now, APP mostly serves larger gaming companies, but with self-service capability, they can tap into the massive long tail of small advertisers. Management dropped some incredible quotes during the earnings call. They asked, "What happens when we can open it up and service all the small businesses in the world?" Later, they added, "We've got one of the most lucrative financial models the world has ever seen." The competitive dynamics are fascinating. APP is directly taking on Meta in digital advertising, but they claim superior performance. Transactions that APP drives typically close within 1 to 2 hours, while Meta has longer timeframes. This faster conversion creates a better ROI for advertisers. Looking at Q3 guidance, they projected revenue between $1,320 million and $1,340 million, with adjusted EBITDA of $1,070 million to $1,090 million. That represents continued strong growth. Dave Inc. Deep Dive, the banking disruptor. Now, let's talk about Dave Inc., because this earnings report was phenomenal despite the stock getting crushed. Dave provides membership-based banking services focused on helping people avoid overdraft fees and access their paychecks early. The Q2 numbers were record-breaking across the board. Revenue hit $132 million, crushing analyst expectations of $114 million. That's 64% year-over-year growth, a record for the company. Adjusted EBITDA came in at $51 million versus analyst expectations of $37 million. That represents 236% year-over-year growth. The company is scaling profitability faster than revenue, which is exactly what you want to see. Let me break down the key operating metrics. Extra cash originations grew 51% year-over-year and 17% quarter-over-quarter. That sequential acceleration is a great sign. Average revenue per user increased 42% year-over-year, which management called a step change up. Customer acquisition costs dropped to $19, with a payback period improving to 4 months from 5 months previously. The company now has 2.6 million monthly transacting members, up 16% year-over-year. While this user growth seems modest, the ARPU expansion more than compensates. Here's what impressed me. Processing and servicing costs were down 4% year over year, while revenue grew 64%. That's incredible operating leverage. The cash balance grew to $105 million from $90 million in Q1. For a company generating $51 million in quarterly EBITDA, that balance sheet is getting stronger every quarter. Looking at full-year guidance, they raised revenue projections from $460 to $475 million, up to $505 to $515 million. That's 48% growth at the top end. Adjusted EBITDA guidance increased from $155 to $165 million, up to $180 to $190 million. That's 120% year-over-year growth. But here's the catalyst that excites me. Dave is raising their monthly subscription fee from $1 to $3. They tested this extensively, and customers are completely okay with the increase because Dave is offering more value. This price increase alone could boost revenue by over $100 million annually once fully implemented. Combined with their growing user base, the revenue runway is enormous. Why the market reactions were wrong. Let me explain why both market reactions were completely irrational. For AppLovin, the stock initially sold off because algorithmic trading systems got confused. Investment banks sent out memos warning of sequential revenue declines in the ad tech industry. But here's the thing, APP intentionally sold its gaming business last quarter, which guaranteed a sequential decline in total revenue. The important metric is advertising revenue, which grew 9% sequentially. The algorithms completely missed this nuance. By the next trading day, smart money stepped in, and the stock rocketed back up as investors realized the earnings were fantastic. For Dave, the stock crashed by 22% despite delivering incredible results across every metric. I think this happened for 3 reasons. First, some investors were concerned about potential regulatory issues with buy now, pay later products. Second, there were questions about JP Morgan potentially raising processing fees. Third, the stock had run up significantly before earnings. But here's what the sellers missed. Dave addressed both concerns directly. They have the pricing power to pass through any fee increases, and regulatory headwinds are diminishing with improved industry practices. Meanwhile, the fundamentals have never been stronger. Revenue growth is accelerating, margins are expanding, and they have multiple growth drivers, including the subscription fee increase. Warren's recommendations: buy, buy, buy. Here are my specific recommendations for both stocks. AppLovin strong buy. My 12-month price target is $520 per share, representing about 14% upside from current levels around $480. This company has one of the best business models in all of technology. 81% EBITDA margins with accelerating growth and a massive addressable market expansion coming with self-service. Position sizing. This can be a 7 to 10% core holding. The combination of profitability and growth makes it suitable for larger allocations. Entry strategy. Current levels represent a good entry point. I'd aggressively add on any weakness below $450. Dave Inc. strong buy. My 12-month price target is $280 per share, representing over 50% upside from current levels around $180 after the post-earnings crash. This company is executing flawlessly with accelerating revenue growth, expanding margins, and multiple catalysts, including the subscription fee increase. Position sizing. This can be a 3 to 5% holding for aggressive growth investors. The volatility requires smaller position sizes, but the upside potential is enormous. Entry strategy. The post-earnings crash created an incredible buying opportunity. I'd be buying aggressively at current levels under $160. Stop losses. For APP, I'd set a stop at $320. For Dave, I'd set a stop at $140. Conclusion and final thoughts. Both AppLovin and Dave represent exactly what I look for in growth stocks. Exceptional fundamentals, huge addressable markets, strong competitive positions, and management teams that consistently execute. The market sometimes gets it wrong in the short term, especially during earnings season volatility. But for patient investors willing to look past the noise, these kinds of overreactions create incredible opportunities. AppLovin is building the future of digital advertising with AI-powered precision. Dave is reimagining banking for the smartphone generation. Both are profitable, growing rapidly, and just getting started. What do you think about these earnings results? Are you as excited about these opportunities as I am? Let me know in the comments below. If this double feature analysis was helpful, smash that like button and subscribe for more earnings breakdowns. Thanks for watching, and I'll see you in the next one.
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.